Should we pursue growth first or profit? Which one is better? What does your research say?
I'm a professor of entrepreneurship. I've been in this game for a while. When entrepreneurship hardly existed, and small firm growth was actually my dissertation topic, seen as a bit controversial.
Louis Roederer. Score cricket.
There are different games, right? So are we talking about creating a sound business that generates profits from its product market so that it can sustain itself and expand and so forth? Or are we entirely in the game of finding the greater fool, right? Someone who's going to pay for this still unproven but perceived or portrayed as promising thing. Profitable growth is, everyone would agree, that is a sound place to be, right? So we say, okay, how do you get there? Do you get there by first becoming profitable at a modest scale? And then you expand this thing that has proven profitable? Or do you go for growth, and as a result of your growth, you also become profitable? And there is quite a lot of theory that suggests that the latter would be something. We're talking about first mover advantages,
yes,
or at least we did back in the 90s.
Pricing penetration
you talk
is like
about
a classic strategy, right? Like you go in low and you capture the market, then you can raise the price slowly.
Scale economies, experience effects, and you have the networks effects as well, which unfortunately applies to very small minority of businesses. So what we showed in that result was that overall, in both countries, in all industries, in all size classes, I think we had somewhat shaky results in retailing or something like that, but otherwise it was very clear, you're much more likely to end up in the star category, above average growth and above average profit at the same time, if you start with above average profit. Right, so profit first. Moreover, if you do go for high growth from a weak profit basis, you're much more likely to transition to the worst corner, namely low profit and low growth in the next period.
Wow.
So it means normally businesses don't become profitable as a result of their growth, and they can't sustain the growth either, because it is expensive to grow, right? On other people's money, and if you don't have a superior product to offer the market, then you won't have any margins. You will have to buy customers by undercutting price and so forth, and that is not sustainable. And next time around, the external investors that you need will not be impressive because you haven't shown profitability. So their patience will run out, and that what happens though, you slump into the living dead category.
I just want to pull you up. What does more likely mean in this case? Like, is there a factor? Obviously, there's like averages between these different sectors.
In most analysis, 2 to 3 times in both directions, right? So they're 2 to 3 times more likely to go to the star category for those from growth, 2 to 3 times more likely to go to the what we call the poor category, the loser category, for those that start from high growth.
Because just the context.
And this is in social science research a very strong effect.